Hey guys, Nick Miller with Exit Real Estate Partners here. Just wanted to do a quick video and sort of break down some numbers, how to calculate your return on investment when you're doing calculating for a rental property and looking to purchase one, what you're going to cash flow per month, what your return on investment is going to be. So let's break it down and let me know what you think. So we're starting out, just sort of went with a $200,000 house for simple math. We got income, you got rental income, which is going to be simple math again. We'll just say you make $2,000 per month on your rental income. Maybe you have laundry in the unit if it's a multifamily, but we're doing single family this time. But if you're doing multifamily, maybe you have laundry, storage, miscellaneous. Maybe you can charge for parking if you're near a train station or something like that. You have extra space there. But we just got total monthly income on this one for $2,000 per month that you're charging the tenant in a single family house. But add up if you have anything else that you can maybe charge people, make a little extra money, and definitely calculate that into your numbers here. Then you're going to go down to expenses, and with expenses you're going to look at, let's say we got taxes. $200,000 house in our area is about $4,500 a year. $375 a month in taxes. You're going to want to have insurance on that property, which would run you about $50 per month. Utilities, we're not putting that in our numbers here, but if you have a multifamily, sometimes they're not metered separately, so the landlord is technically the one that's going to pay for the utilities, and you just got to calculate based on what you're charging per rent to cover those utilities, because you're going to be paying for them. Lawn and snow, again, single family, most of the time the tenant does that, but if you're going to be doing it, make sure you calculate that in there. Vacancy, you want to calculate for the times that you're not going to have a tenant in the house. So say a lease ends, that time between leases before you get someone in there paying you rent again, you want to calculate that in, and I usually do about 5% is a good number I use, so it comes out to $100 per month that you're going to want to set aside for that vacancy between tenants. Repairs, I usually do, it depends on the property and the condition of the property, how new stuff is in the property, but we're going to put $50 per month on this that you're just saving for repairs on the property. CapEx, or capital expenditures, is bigger things like a roof, siding, driveway, anything like that. So it's going to vary per property. Can't really tell you what a set number is or what to calculate. You're going to have to sort of go over the property, look at the big items, and come up with what you think is going to need to be replaced in the near future, and then put that into your numbers. So we went with $100 per month, so you're saving about $1,200 a year in a savings account just for the big repairs. Property management, in our area, you're probably going to see around 10%, but it really depends on what they do. So we put that as $200 per month. Mortgage on a $200,000 house with 25% down. For principal and interest, you're looking at about $800 per month. So our total expenses on the property is $1,675 per month. Now once you have your total expenses, you're going to want to figure out your cash flow. So you want to take your income, your $2,000 per month that you're going to be making in rental income, minus your expenses, which is $1,675. That gives you your total monthly cash flow of $325 per month. Now once you have your total monthly cash flow, you can start looking at your return on investment. So on the $200,000 house, you're looking at your down payment of roughly $50,000. That's with 25% down. So calculate differently if you're putting a different percent down, but most lenders want to see 20 to 25% down, and you actually normally get a better rate if you put the 25% down compared to the 20%. Then you're going to want to put closing costs in there. I estimated roughly about $4,000 in closing costs. Rehab budget, say you want to do carpet, paint, whatever else before you put a tenant in there to maximize your rental profit. So we're going to put about $5,000 into the property. Miscellaneous, if there's anything that doesn't fit into these, you come up with, put it in that miscellaneous. So total we have into the property with down payment, closing costs, rehab, $59,000. From there, you're going to want to take your monthly cash flow and get your annual cash flow. So take your monthly times 12, get your annual cash flow of $3,900 per year. Then to get your cash on cash return on investment, take your $3,900 monthly income or annual income, divide it by your total investment in the property, which is the $59,000. You're going to get a number like that, so you want to move the decimal place over 2 spots. Gets you 6.6% return on investment. Now when you're starting to invest, you have to come up with what's a acceptable return for you. It's going to vary by neighborhood, by town. So if it's in a very nice neighborhood that you see appreciate very well, say the properties are appreciating 3 to 5% in that neighborhood year over year, you're probably not going to get the best cash flow on a property unless you find a smoking deal. But you're going to get the equity over time and that appreciation in value on the house over time. Whereas if you're in sort of a worse neighborhood that doesn't appreciate as much, you better be looking for a better cash flow per month, because you're not going to see the appreciation, which will help your return over time. So for this, I mean, it might be 6.6% yearly return on investment, but over the long run, you may be looking at maybe a 15% return total. Let's say 10 years down the road, your house has appreciated 3 to 5% per year. I didn't figure out the total math there. You'd have to sit down and see what that would cost, what you would make year over year, and then minus out realtor fees after selling and everything like that, and you can come up with a longer term return on investment, adding in the appreciation. But just a quick rundown, you see yearly you're going to make 6.6% on what you have invested, and that's without appreciation on the property. So there's a lot more to break down, but this is a quick breakdown of the numbers and lets you see a big picture on what you're going to get back if you do purchase the house and rent it out. Hope this helps. If you have any questions, throw a comment down below, and if you want to see me break down any more numbers or address any other investing concerns you have, let me know. Shoot it in the comments too, or you can shoot me an email. Have a wonderful day, and as always, like or subscribe to the channel or my Facebook page, and keep an eye out for future videos that can help you gain a little more knowledge in real estate investing.